Hey guys, it's nice to see you again. So recently, a mutual fund scam took place, and those who don't know, Axis Mutual Fund was the fund house that was involved. And to be precise, these two legends, Videsh Joshi and Deepak Agarwal, were the accused fund managers. Now you will think, what have they done, right? Basically, they did price rigging and front running. So what is price rigging? So basically, when parties try to fix or inflate prices to achieve higher profits at the expense of the consumer, that is price rigging. And let me tell you, it is illegal in India. Talking about the front running, the illegal use of advance information that is leaked to the brokers by the mutual fund staffs. Basically illegal, and that is called front running. Okay. Actually, this is not the first time we are hearing about a mutual fund scam, right? The UTI 64 scam, the CRB or the chain group Bansali scam are the well-known scams of mutual fund. So now you will ask me whether you should invest in mutual fund, and is it safe enough? Well, to know the answer, watch the video till the end. And now without further ado, let's roll the intro. So let's start from the beginning. It starts when the RBI and our Indian government decided to form UTI, or the Unit Trust of India. You might remember in Scam 1992 series, the UTI was seen. So it was the first step towards mutual fund in India when UTI was formed back in 1963. Okay. So back then, government used to motivate people, especially from the lower and middle income groups, to invest. So that's how it started. However, the concept of mutual funds was first brought in early 1770s in Europe. A Dutch merchant named Adrian van Ketwijk created world's first mutual fund in 1774. Okay, what he did, he pooled money from several individuals like you and me, or some investors, large capital wale investors, and diversified the investment into bonds, equities, debts, and that's what today also the mutual fund does. They take our money, then the group of experts, let's say the fund management team or the group of experts, invest them into equities, bonds, debts, and also there is institutional investments as well. All they need is a high return, and when they get that, they divide the high return and distribute to their investors as well, taking a small charge, or it is called the expense ratio as well. So that's what mutual fund is. Okay, so there is also a dividend part as well in the mutual fund, like the stock market. So what is dividend? Dividend generally means if the company gains a higher profit, then it will share some percentage of the profit to its investors like you and me. So that is dividend. So there are some points and financial terms as well that you need to know before investing, and listen to this very carefully. So number one point is always invest in small and medium risk funds. Like there is HDFC, there is Kotak, there is Edelweiss Equity Savings Fund. Those are all low risk funds, okay, and moderate returns. So invest in this type of funds. I am not suggesting you that, but invest in lower and medium risk funds. Okay, so that's the number one point. So point number two, do SIP or systematic investment planning instead of one-time investment. Now you'll ask why? Because if you buy a mutual fund today and the price or the NAV value is, NAV means the net asset value, or the current price the mutual fund is running on. So the NAV value is say 100 rupees, and the next month its NAV becomes 90. So your average buying price is decreased to 95. That's why I always suggest you to do SIP instead of one-time investment. SIP is more beneficial. Okay. So point number 3, always research about the fund managers. The reason I have explained in the very beginning of the video. Okay, so you know now why you should research about the fund managers. So that is a very important point. Okay, so research about the fund managers. Now let's understand few terms. Okay, so I will use Grow app for that. So the first term is the expense ratio. I have already discussed what expense ratio is. So the AMC or the asset management company or the fund house charges some fee for their research. Okay, so it is the expense ratio or the commission. The second is the exit load. So if you exit out from the investment before the completion of the time period, so let's say there is written that the exit load of 1% if redeemed within 15 days. Okay, if you redeem before 15 days, you will be charged the exit load of 1% of the investment you have done. Okay. Third one is the stamp duty. For the units allotted to you, registrar and the transfer agent or the RTA will charge you a stamp duty. Okay, so that is applied from the July onwards, July 2020 onwards. So before that, no stamp duty charge was applicable. So here you can see 0.005% is the stamp duty charge. And the last one is the tax implications. That means if you redeem before 1 year, you will be required to pay a STCG tax. Now STCG is short-term capital gain tax. Okay, in this case it's 15% and above. Okay, if you redeem before 1 year, and if you redeem after 1 year, flat 10% is charged as LTCG or long-term capital gain tax. Okay, so that's it for the video, guys. I tried to give you an overview. Now it's your duty to do your own research and invest smartly. Hope you like this video, and if you do, please hit the subscribe button and share this with your friends. Thank you. Have a nice day.